Securing up to $5 million in commercial capital usually requires handing over massive amounts of equity. But by utilizing the Small Business Administration, or SBA, founders can unlock that same $5 million with a down payment as low as 10% and stretch the repayments out over 25 years. But accessing this capital requires a severe operational toll. You pay for these favorable terms with weeks of your time, a complete loss of financial privacy, and a rigorous federal underwriting process. Closing an SBA loan takes between 60 and 90 days. If your business has a sudden cash flow emergency and needs to make payroll next week, this program will not help you. The government also demands strict accountability to mitigate their risk. Anyone holding a 20% or greater equity stake in your business must sign a mandatory personal guarantee. Signing this guarantee legally binds your personal assets to the business debt. To secure the loan, the lender will collateralize your personal property. In many cases, this means placing a lien directly on your primary residence. This creates a stark operational paradox. The favorable 10% down payment preserves your company's operating cash flow, but if the venture fails, the founder absorbs the entirety of the personal financial fallout. An SBA loan shifts the financial burden of failure from the business entity to the individual. By trading corporate leverage for a personal guarantee, the founder anchors the debt to their own life savings and home equity. In March 2026, the cost of entry changed. The SBA implemented new eligibility criteria through their updated SOP 5010-8 guidelines. Under the new rule, 100% of the borrowing business must be owned by U.S. citizens or U.S. nationals with their principal residence in the United States. This policy explicitly excludes legal permanent residents. Green card holders are now barred from applying for SBA-backed loans. The ownership threshold is absolute. If a permanent resident holds even a 1% indirect ownership stake in a holding company that owns the applying business, the entire application is disqualified. Prior to this 2026 rule, the guidelines were entirely different. Legal permanent residents were permitted to own up to 100% of an SBA-backed business and access the exact same leverage as citizens. The SBA stated this policy revision was created to align with a recent executive order titled Protecting the American People Against Invasion, bringing immigration enforcement directly into commercial lending. Immigrant founders currently seeking capital now face a dilemma. They must either execute a complete buyout of any non-citizen equity partners or abandon the SBA entirely and seek more expensive financing on the conventional market. The SBA has added a layer of identity verification to its financial review. Approval now depends as much on the owner's passport as it does on the company's debt service coverage ratio. For those who do qualify, the SBA 7A program is the versatile workhorse of the system. You can use these funds for almost anything, from a partner buyout to acquiring a competitor or general working capital. The financial draw of the standard 7A is volume. Borrowers can access up to $5 million, and they typically only need to bring a 10% equity injection to the table. This graph illustrates the structural danger of the 7A loan. It compares a steady, fixed-rate line against a volatile variable rate. Standard 7A loans are tied to the Wall Street Journal prime rate, a benchmark interest rate that banks use to price loans. Because this rate fluctuates, your monthly debt obligations can spike without warning based on the wider economy. Because the funds are highly versatile, lenders take on wider risk. They compensate for this by placing blanket liens on all available business and personal assets to collateralize the loan to the maximum extent possible.
If your business cannot wait 3 months for capital, the SBA offers a direct alternative, the Express program. The Express loan bypasses the standard 90-day wait. The SBA guarantees an initial decision in just 36 hours, allowing the lender to fully fund your business in roughly 30 days. But speed is expensive. The first major trade-off is capacity. Express loans are strictly capped at a maximum of $500,000. The mechanical reason these loans are harder to qualify for is the government's backing. On a standard 7A loan, the SBA guarantees up to 85% of the debt. On an Express loan, they only guarantee 50%. With the government absorbing less of the blow in the event of a default, lenders absorb more risk. To offset that exposure, banks charge higher variable interest rates and demand stronger personal credit scores from the borrower. The choice between the standard 7A and the Express program is a direct trade. You pay a premium in interest rates and strict borrowing caps to buy back your own time. If you are an established business owner looking to execute a massive capital project, like acquiring a new warehouse or purchasing heavy long-term manufacturing machinery, versatility matters less than stability. This diagram shows the SBA 504 loan, a tool built exclusively for major fixed asset acquisitions. The debt is split into 3 slices. A conventional bank covers 50%, a nonprofit partner covers 40%. By law, you must partner with a Certified Development Company, or CDC. CDCs are community-based nonprofit partners regulated by the SBA to promote economic development. Closing a 504 loan is a rigorous process. As the borrower, you have to simultaneously survive underwriting from your conventional bank, the local CDC, and the federal SBA. The 504 loan offers 25 years of fixed-rate certainty. Accessing it, however, requires a triple-layer approval process involving a private bank, a regional nonprofit, and the federal government. Succeeding in the SBA ecosystem means ignoring the marketing and matching your exact operational priority to the correct federal program. This flowchart maps the decision. For real estate or equipment, the 504 loan locks in a 25-year fixed rate. For versatile capital, the standard 7A provides volume despite variable rates. For capital in weeks, the Express Path offers rapid funding with a $500,000 cap. Identifying the right program is the first step, that the actual bottleneck is the lender. Finding a preferred lender, a bank with the delegated authority to approve loans without a direct federal review, requires vetting institutions against a 100-page SBA manual. Applying blindly to a random local bank often results in months of delays and rejection, simply because that specific institution lacks the dedicated staff or authority to actively process SBA loans. You can bypass this friction entirely. Utilizing a dedicated matching network connects you immediately with active, preferred lenders who specialize in your industry. By inputting your data once at BusinessLoan.Directory, you gain access to a network of vetted lenders ready to deploy the exact $50,000 to $5 million product you need, transforming a bureaucratic maze into secured capital.